Okay, so thank you for inviting me to discuss this paper. Valentin was my student at Chicago. It's a pleasure because it's something that I think is important. So let me just tell you in 2 lines what the contribution of the paper is. It provides a simple testable prediction of the relative impact of intermediaries on the risk premium of intermediated asset classes. So essentially, more intermediation, they imply a higher elasticity of a risk premium to change in risk aversion of the intermediary. It's very intuitive. And the nice thing is to try to quantify how important it is, because we do believe that also households got to play a role in the real world. It's not that they are completely shut off from asset markets. And they provide, and I put here some evidence supporting the prediction. That's going to be my main bottom line. I think you need more. But I think the question is very important, very interesting, and it's a good thing to do. So, I'm going to outline the discussion in a little roundabout way, because I want to show you what is the benchmark at the end of the day. Because it's interesting to talk about how important the intermediaries are, but at the end of the day, first of all, we need to know what is a good benchmark to even discuss these issues. And then, I'm going to, as I say, question on empirics. I have a couple of questions for the authors. So, I go back to the beginning, if you want. If you're a frictionless model with many agents, each born with a tree. So you're born, you have a tree, and it's this could be just human capital if you want. And there is a common shock and a potential idiosyncratic shock. Standard asset pricing model. Agents don't like idiosyncratic risk normally, so they would not like to keep this tree on their own. Okay? So what they would do, well, set up a firm, issue equity, let's call it P, and sell it to somebody else. Okay? Because they don't like idiosyncratic risk because it's risky. That's by definition. And so this would be a claim to D. Otherwise, they maximize their nice intertemporal utility, potentially with some state variable, risk aversion of the household. I'm not going to put any details here, but standard maximization. The initial wealth of this agent will be nothing more than the value of the tree. You sell it 100, that's your wealth, and then you go on for the rest of your life. And then you invest in the aggregate stock, because that's the part that all the idiosyncratic risk get diversified away, and then borrow land depending on your risk aversion that will be in there. Okay, nothing new here is a standard asset pricing model. Let's say, now let's put in this standard asset pricing model an intermediary. How would you put it in there? Okay, well, it's very hard for me, if I have a tree, to start selling shares anywhere. First thing I would do is to call a bank or a place that allow me to actually do that, because I don't know how to do it. Well, let's put the intermediaries are passive, just facilitate the risk transfer. I want to take my idiosyncratic risk and give it to somebody else. Okay? So what are the assets of this intermediary? Well, I would underwrite my equity issuance to whoever, for me in particular, for individual firms. And then we'll make loans to households to help finance their dream consumption, because they are going to want to have the best possible consumption, want to have my beautiful house. I'm going to borrow, okay, if I am risk tolerant. What are the liabilities? Well, this intermediary will issue itself equity, okay, potentially, and to the market, so therefore back to us, in a good way. And we also receive deposits from the households, who instead, now I see that these are still D for deposits now, before was dividend, written in a hurry. Anyway, so the deposit from households, and who would put the deposits? The risk-averse people. So if different people with different risk aversion, some people have low risk aversion will get the loans from the bank or from the intermediary, other ones put deposits in there. Again, nothing new here. The thing is that it will look like something like this at the end of the day. Okay? So I have on the left here, I also can do this big picture, intermediation in a frictionless economy. So you have all these risk-tolerant agents on the left. Okay? So they have asset and liability. They started out with a tree, and then they sell it, and so now it's on the other side. They sell the claim, so to give all the dividends to the other person, to the bank. The intermediary here buys it. Okay, so here it is. They were all colors, by the way. Also a lot of red in here that you don't see anymore. So, it's harder to see. You see that some still show up. And then they get the loans to buy their consumption. What is that thing here? You know, the intermediary is here in the middle, is going to receive the deposits from whoever make a deposit. It would be the agent with higher risk aversion. These are risk-tolerant agents. Those are risk-averse agents. And this is going to liability, is going to issue share. S1 is the share of the intermediary. Notice the intermediary is going to have a lot of trees on the assets. And so this, you know, is going to diversify all these things at the end of the day. If you have 1 million of them, that's it. You only have a market risk or aggregate risk. It's going to issue this. Who's going to buy these things are the agents themselves. That's what they do. So that's the portfolio of agent 1. It's N, actually agent 100 in this case, you know, want to have a particular share of that particular intermediary. And here is another intermediary, and you have many of them. Okay, it's just a big web of things, all frictionless. You don't need to have any frictions in here, but it is how would happen the risk transfer between people. Okay. Now, we can actually study what happens to the balance sheet of the intermediary. Okay, that's my main point. Okay, so, you know, things happen in the economy. Let's look at how this intermediary balance sheet changes over time. Okay, so suppose, for instance, that agents' risk aversion, agents are not the intermediary, just the households, differentially change over the business cycle. There's no reason why during the business cycle everybody's risk aversion go up at the same level. You know, there are some people who become really risk averse, so they have to send the children to college. Other people who don't care, don't have any children, so, you know, they double down when the stock market goes down. It's perfectly fine, you know, that happens. But, you know, the variation risk aversion differently across people just make reasons to trade, motives for trade from each other. And therefore, they change the allocation of what? Of the intermediary. You know, it's the only thing they buy, and so they're going to buy different intermediary assets. So something like this is going to happen. In good times, risk-tolerant agent increase the stock holdings, increase debt, and risk-averse agents have to, you know, market has to clear, somebody has to sell, decrease the stock holdings, and increase the deposits. These deposits go to finance the debt of the other guys. What happens to the intermediary balance sheet? Well, the equity value is going to go up. We are in good times, and so prices go up. That's a good thing. The overnight debt is going to go up because now there are more deposits, but they also lend more money, so everything is going to flow from one side to the other. And in that model that Tan and I put together, debt to market equity actually drops. Okay? If instead you're in bad times, you get exactly the opposite. Stock holdings of the risk-tolerant drop. They want to sell. It's not that they become just poorer. They actually decrease their position in stocks. And they decrease debt. You know, they use it to buy them their liabilities, and the stock holdings instead of the risk-averse agents increase, and they decrease the deposit, so they liquidate to buy them. And again, you know, the intermediary, of course, balance sheet is going to move in the opposite direction. Okay? This could be actually pretty dramatic movement, even if we are in a perfectly frictionless economy. So here is a simulation. I took it from my other paper, and in which we are in a heavy formation Campbell and Cochrane, no more, no less. And the first 4 panels here would show up in Campbell and Cochrane model modified to have stochastic volatility, but it's essentially Campbell and Cochrane model. You have a surplus consumption ratio up here, going up and down. This is a crisis. You know, when surplus consumption ratio is low, that's bad times. Remember that. That's economic uncertainty, stochastic volatility we have in our model. A price-to-earnings ratio go up and down, and return volatility move up and down. These 4 are there in the heavy formation model that Campbell and Cochrane, more or less, besides that, worked out. The important part is instead the intermediary, which is at the bottom, and instead is a total aggregate debt over output. You know, you have to renormalize by something. Let's say output, you know, drops in times of crisis. So intermediaries, total debt, which would be, we call essentially book leverage, just drop in bad times. They just delever. Okay, so the intermediaries delever. Instead, the debt-to-wealth ratio, so which is the debt-to-equity ratio for them, goes up. Why does it go up? They're delevering, so the amount of debt is decreasing, but equity goes down much faster because there are these huge discount effects. And so, you know, you find these 2 variations. And, you know, that's what we do in the paper. It says, well, you know, do these explain stock returns of the cross-section? Okay, because this has been the discussion has been going on in intermediate asset pricing. Well, in our model, which is a heavy formation model, liabilities are just passive. They have this intermediary in there, but doesn't do anything. Well, you can always compute the debt as some function of aggregate risk aversion. In our model, it turns out to be a function. And you can write the risk premium as the covariance of return with the log consumption, so the log utility. We have log utility in the paper. I should have mentioned that. And then there is a component that is the intermediary leverage risk premium. But this just coming because we can always redefine it. It's a complete market. So you can define the risk on anything, any possible proxy. So long as it's correlated with the real risk factor, that is going to work. Okay? So intermediaries leverage is priced because it proxies for aggregate risk aversion. It's not risk aversion, but it just proxies for it. Okay? And in fact, we find that the model produces a bunch of results that are the ones that you see in the data. So, for instance, we can replicate the fact that if a price they found French portfolios, at least in simulations, the colors don't show, and also the predictability with different signs, whether you use book leverage or market leverage, we have the same in our model. Okay? Let's go back now to the idea of Haddad and Muir. So the intermediaries balance sheet expand and decline even without any frictions. Okay? Goes back to economics, if you want. However, there are frictions. We all believe there are frictions in the world. We don't believe that we just need a benchmark to understand what we are looking compared to. Okay? That's the part. It's not that, in a frictionless economy, all these effects are not there. They are there anyway. The question is all about magnitude. So that's what they are trying to do, to say, well, how much more the intermediate risk aversion actually affect risk premium. Okay? So that's the interesting part. And the impact should be especially visible on assets that are more intermediated. And so you rank assets in order of household cost to hold them, and that's the result that Tyler mentioned. Okay? So that's the elasticity result. So this is the ranking. Okay? Stocks, bonds, options, sovereign coin. You saw this picture from him. I'm going to go back to this in a second. And then you need to find proxies of intermediate risk aversion. So they use those two quantities I said before, the book leverage and market leverage, one way or the other. Maybe it's inverse, but it's about that. And the GZ spread and chi, etc. I was there. I said, well, I have those two in my simulation. I just showed you the implication of simulation. What does it imply for that regression that they're doing in my frictionless economy? I can just do that. Okay, I have all my simulations. So in their model, they show, in their paper and empirically, they show the elasticity get bigger for the ones that are more least intermediated. Okay. More intermediated. And those are the numbers. By the way, these are not in the same order of this one, so I had to go back and figure out which one is which. So the first two are right, but then there is the 3s here, 4, 5, 6, 7. Put them in the same order, at least it doesn't have to look. They're supposed to go up monotonically, but you can tell from the random assignment. But anyway, so that's the result. And there is some monotonicity. There is something, I'm almost done. Something in here, commodities and CDS. These are the big ones. I completely buy that. Household don't buy CDS normally. Okay? There is a lot of evidence on that somewhere else. However, this ranking could be correlated with many other things, right? So it could be implicit leverage on these securities. CDS are extremely leveraged securities. Could be their beta, their liquidity, other true risk factors. And from the paper, I couldn't figure out how those effects enter into the picture. Okay, that's my main problem. In fact, if I take my simulation and I have these assets which are ranked on illiquidity, I get the same. So this is elasticity of risk premium versus the implicit leverage. But the x-axis is the implicit leverage of the asset. How much leverage it is, because I have all of them. And you see the elasticity goes up. I think I'm using the opposite sign than what you use, but those ones have a higher elasticity than this one in my frictionless model. And I think that just because these are less liquid in some sense, I have a higher beta if you want, but let's call it in there. And so I don't know. I would like to see a little more controls for other things that there are robustness controls, but. Yeah, that one. And then, again, the intermediate risk aversion versus these proxies. Again, the specific implication of the model is about risk aversion. These proxies are not risk aversion. They are sort of revealed preference, like how much you borrow, what is the balance sheet. It's correlated vaguely with risk aversion, but it's not risk aversion. So maybe you should find what are the predictions for those variables that you actually do use in the regression. Not proxying the risk aversion with these two variables that are interesting, but they are not risk aversion. And so I would say that at least the model should try to do that. That's it, I'm done. The question is interesting and important. I'm still not swayed by the evidence. I think that you need to do a little more work. But that's my 2 cents.